Good morning, everyone, and welcome to another installment of the Prosperity Through Multifamily Real Estate Investing Podcast. As always, I'm your host, Real Estate Cody, and with me again today, the coffee connoisseur himself, Mr. Brian Alfaro. Brian, I'm fired about today's episode. This is going to be a good one.
Oh, yeah. We're going into a new year and we got a great guest on the show who's going to drop a bunch of knowledge bombs today. So I'm super excited to talk real estate today and dive into the show.
Yeah, man, let's just jump right in. Tell us who we're talking to today.
All right. Today we've got Terry Painter. Terry is the author of The Encyclopedia of Commercial Real Estate Advice, which is published by Wiley and a contributing writer for Forbes.com. He is the founder of Apartment Loan Store and Business Loan Store, commercial mortgage banking and advisory firms that have closed over $4 billion in commercial loans since 1997. Known as a syndication financing specialist, Terry loves working on real estate deals and has personally closed hundreds of commercial real estate loans representing just about every type of commercial property. He has been a top producer for LaSalle Bank and Lehman Brothers and is known for his real estate investment consultations. For 18 years, Terry has spoken nationally to commercial real estate investor groups, real estate brokers, and banks about commercial real estate investing and lending. Terry is a member of the Oregon Bankers Association, the Mortgage Bankers Association, and Forbes Real Estate Council. Terry, welcome to the show.
Hey, thanks for having me.
Absolutely,
Cody, go ahead
Terry.
and highlight this background here before we, for anybody who's not watching.
I was going to say, man, well, first off, Terry, is there anything that you haven't done in the commercial lending space or commercial world and at all? But yes, for those who cannot see you on screen, Terry has this very beautiful, almost
it looks like a virtual background.
It looks like a virtual background, but
real.
It is not. It's real. And I wish we were sitting out there having this live meeting in his office. But Terry, where are you at again? Dominican Republic?
Yeah, my winter home in the Dominican Republic. Yeah, yeah. So it's just the way everybody when it gets for your investors and so on. It's really important to design your life based upon who you are in every way, including where you live. So yeah.
Well, it's absolutely beautiful back there. It looks like a piece of paradise out there. So, man, again, Terry, glad to have you here. You know, as Brian alluded in your bio, I mean, just an extensive background in the commercial real estate space, you know, and so just really looking forward to diving into that, learning more about your expertise and really kind of what we're talking about before the show, right? Just what we're seeing in today's world of, commercial real estate investing, apartment syndication, and kind of go through those dynamics. But before we get into that, man, tell us a little bit more about your background and kind of what got you here to today.
Yeah, thanks. The thing about me is that I get bored easily, and how I ended up in this business. I had a small chain of French bakery and restaurants. And the problem is that after working in one for about 4 or 5 months, I just wanted to build another one. I just got bored. And so that was expensive. So my wife at the time and my banker just told me you cannot build any more restaurants. So I had to find a different career. And about 25 years ago, I had a banker buddy. I loved what he did. He was so excited about going to work every day, which a lot of bankers are not that way. But that has actually become my life now, where I literally to this day, I'm not that young anymore, but I can't wait for the weekends to be over so I could just get back to working on deals and evaluating them. And, so it's just fun for me. And there's so many different moving parts. I love the different economic cycles, just like what's going on now in the marketplace is something that I have to say I have not quite encountered. And that makes it even more exciting for me to just try to make deals work where prices are so ridiculously high and overpriced. A lot of my clients have these great ideas for value adds, but they don't really if they really can't estimate the cost of those accurately, they could probably pull it off. But yeah, so it's a really exciting job. I don't ever want to retire. That's kind of a sore for my wife because she would like me to work less, and so we're kind of compromising on that. But otherwise, I just love working on commercial real estate deals. And I love and the people that invest, including the passive investors, are just they're entrepreneurial by nature, and they're just really interesting people to work with.
Got us a deal junkie in the seat, Cody.
I know. I love it. And listen, it's not work when you love what you're doing, right? It's right. So that's great. And obviously, like you said, you've developed your lifestyle by design. And just to reference where you're at now and just sitting in paradise and just having a call with us. I mean, obviously you love what you do. So that's awesome, man. We appreciate you being here. And, I want to highlight the fact that, like you said, you've been in the industry for many, many years now. You've closed over 50 syndicated transactions, on the debt side. And you've seen just multiple economic cycles through your career. And then, as you mentioned, now we're sitting in today's time where I think everybody is scratching their head wondering what in the world's going on. I don't think anybody has anticipated that we would see what we're seeing now in this post-pandemic recovery. So I want to kind of dive right in there if we can.
Yeah, I'd love to talk about that. That is like, whoa, it's like off the charts today with like, what do you do? Like what makes sense? Yeah.
Yeah. Well, let's start right there, man. Let's kind of compare what you're seeing today in this world versus kind of what you've seen in previous economic cycles.
Sure. Well, today is totally unprecedented. There's never been anything, as far as I know, quite like what's going on right now, just in the sense that, as everybody knows, the housing market has exploded price-wise to, which has actually created more renters. So at this time, there's the highest demand, I think, almost on record for multifamily housing. And rents have actually shot up, are now averaging increases this last year, ending in October, of just throughout nationally about 10%, and it's usually more of increase, like maybe 5 or 6% annually. And so, but what we're talking about is commercial real estate, which also should have a ceiling. Like one of my favorite sayings is, where I always ask people, well, how is commercial real estate like an elevator? And I'll tell you the answer. The answer is that it has a top floor and it goes up and down. So your job as a real estate investor is to mitigate for rents being flat for a while, for there being very little income from operations for a while. And just you have to be more cautious. If anything, it's a time what we're seeing now is actually, because we do loans all over the country, even though we're primarily located on the West Coast, but what we're seeing is friggin' C properties going for the same price with cap rates as low as B properties. Now, that's something I have not seen before. And that does have to do with a shortage of properties, where in the residential world, just because there's a shortage, there's a lack of inventory of homes on the market, and more millennials who finally decided they're going to buy a home now, and just those people who do have the money to buy a home, those are getting snatched up at very high prices. But what you've got to realize about commercial real estate is it's always been constrained by the net operating income. And if you're going to be putting financing on it, you also have the debt service coverage ratio. So that's my world. So, the question is, okay, so if there's ever been a time, if you're going to be investing in a syndicated transaction, at this time, you really do, my recommendation is to go with an experienced sponsor, experienced sponsor, because it's just they're going to be able to, hit it right more, because of their experience. I have to tell you that I've certainly done quite a lot of deals actually with newbie syndicators as well, but this is probably not the time, right at this moment, because there's just so many inherent risks.
Yeah, I think, with the way the space is moving right now, where the needle keeps getting pushed feel like every week, right? You think like, okay, you got an idea on where the market is, and then the next week somebody comes in and pushes the valuation again, or purchases a property at a certain level. So going back to your example of the elevator, where commercial real estate has that ceiling, right now it's kind of hard to imagine where that ceiling really is, because it doesn't feel like there is. I mean, we're looking at, product that we would look at just early in the year, for example, that's now trading for, 10, 15, almost $20,000 more a door, sometimes even higher. And there people were getting it. We were looking at a deal yesterday, Brian. We got a call from a broker that deal we're looking at. Somebody came in $2.5 million over the whisper price, and got the deal under contract. So that's to me is like, I think there's always underlying fundamentals that you have to absolutely build your business on. But at the same time, it's like, man, where is the ceiling coming?
Yeah. And the thing about it is that, so what happened in the Great Recession is that everybody forgot the recessions before that. There was a 6-year bull market. The prices just kept going up. Everybody said, well, I better get in on this now because they're only going to go higher and they're only going to go higher. And people kept buying at higher prices, including in commercial real estate. And so a lot of people did find themselves at the top of the market when the recession happened. And there's really as long as you plan for recessions, in your investment, you can make those pretty darn bulletproof, even at a time like this. But as far as determining what the ceiling is, going back to the Great Recession, is that we had all kinds of elements in place that were not based on fact, not based on reality. We had appraisers that were colluding with, in fact, we even had appraisers that wanted to work for our company that would say, well, just tell me what you need the price to be at back in those days. If anybody had, we used to say, if anybody had a pulse and a 640 credit score, we could probably make a loan to them. But it's a different world now, fortunately. But you have to realize that the problem is that the reason the real estate market collapsed in the Great Recession was not only because of the subprime, nonsense that was going on and the collusion and all that stuff going on with large, banks like Goldman Sachs and so on, and Countrywide, and what was going on with the premiums they were earning, but also it did not fit with reality, like what somebody who was earning, let's say, $60,000 could afford for a home. The same thing as far as commercial real estate now, because it should be, as far as economics go, it should always be constrained by the net operating income, and also market rents. So always keep in mind that as long as rents increase, property values on the commercial side go up as well. When rents are, but we're also seeing what's kind of scary to me is that so many of my clients bring us deals today that are based on smoke and mirrors because there's such a demand for multifamily, especially, that the listing agents are just actually selling more on pro forma. They're selling, when you really get the financials, you realize, hey, this is not what I thought I was buying. And so you have that compounding, very high prices. So anyway, it's an interesting time.
It is a very interesting time. You're right. And those are all great factors to point out. And, just going back to the comparison of like the Great Recession, though, you never want to say, oh, this time is different. But as you pointed out, you had subprime loans and lending practices that were, definitely malpractice for sure, which we no longer have that in place today. But you also have this significant supply and demand dislocation, right? You have a very high demand for the affordable housing space, multifamily in particular, but you just don't have enough supply. And even at the development, we're not able to produce development fast enough to fill that void. And then now you take in the pandemic effects, right? The supply chain interruptions, the cost of production, lack of labor, all these variables.
Right.
Are you finding that is going to continue to drive the commercial real estate space in a positive trajectory over the next few years? Or
I'll tell you, in my opinion, from my experience, what really will drive the commercial, let's just talk about commercial deals. What really drives them is somebody who's really smart and working smart and making a lot of the right decisions. Now, don't get me wrong that, because prices are so high, it means that you shouldn't buy at this time. What it means is that you've got to dot all your I's and cross all your T's and actually have a plan, maybe, a plan to really make sure that this property is going to be successful. And that's where it gets back to if you're going to be doing a syndicated transaction to, to an experienced sponsor, and also who will also already have together an experienced team. So it's a really rough time to just go out and try to buy a piece of commercial real estate or an apartment building just on your own if you're a newbie. Even if you've had success with, let's say, owning 6 or 8 residential homes, rentals, just suddenly jumping into, those homes are going to go up in value quite a bit because it's really based totally on supply and demand in the marketplace. But once again, the commercial properties have that top floor on the elevator where all of a sudden, man, does somebody really want to have to put 45% down on a property today that, a year and a half ago, they could have, they could have put 25% down on, do they really want to let go of the first 2 years of operations because it's priced so, of the income from operations because the property is priced so high? So
yeah, like you said, man, very interesting times. And Brian, doesn't that sound so familiar? We were just having this conversation over the past couple of weeks, right? About, the barriers to entry as a novice investor, just some of the challenges. We're hearing this from experienced operators ourselves, right? Where even they're scratching their heads wondering, man, where is this going to keep going?
Yeah. So the thing about it is that it does get, okay. So if you think about buying a C property, like where I live in Portland, Oregon, let's say if you think about buying a C property at a 5.4 cap today, the question is, can that C property really get down to like a 4.7 cap over the next year? Okay. That's a question because it's really going to be constrained by by rental increases for one thing, but also what's also driving the market right now is there's just a lot of folks that have made a decision to do a 1031 exchange where they're buying properties with money that they earned from appreciation years ago, and so it's not the same as somebody who wants to just get into the real estate, the commercial arena today and buy a property with money they've worked hard to earn. Does that make sense?
Yeah, absolutely. And we've been victims of losing out on opportunities from people coming in with 1031 exchanges. Yeah, we know that pain all too well.
Yeah. So, but my thought is that there on commercial real estate that there is. In fact, I'm in the process of writing a Forbes article right now on that subject, and just to take a look at, just to take a look at why there is a top floor, so to speak. Now, all it takes, like one of the things you mentioned, Cody, is that development has really been slowed, and that the Corona recession really hit that hard, mainly because banks didn't know where the market was going to end up, and they just stopped making loans on new construction, on ground up construction. And then in my book, I have a great section, 2 chapters on development, and it really goes through the entire process. When you see what it takes to actually develop a new multifamily property, it could take 7-8 months, just even a year to get through the city and get your entitlements and be ready to be shovel ready and get your building permits. Then you've got to by that time you spend so much time, you've got to get new bids on your construction usually, and so on. There's just, it's a lengthy process, but eventually it will catch up because there's such a demand. I assure you that it will catch up to where the supply is today. There will be more supply.
Yeah, development, obviously, I think it makes a lot of sense right now. Like you said, if you can get through the entitlement process, if you can get supplies, we're hearing developers having same challenges as most of everybody, getting access to their raw materials to do development. And then we talk about the labor shortages. You're seeing a massive competition for skilled laborers in this space because they're not there, so now you have.
That's a really good point, Cody. That is really compounding the problem many times over. And yeah, it's also contributing to labor costs going up right now as well, new construction. So yeah. But what I don't want to, the thing about it is that there's mitigators you could put in place today to buy property, because we could assume, let's just assume right now that for a while, prices certainly are going to keep going up, or at least staying where they're at on the commercial real estate side. So it's not to say that if you work smart, that you can, for the right deal. It just means that if you're bringing in investors, the investors have to be realistic. You got to be one team, the sponsors and the passive investors, as far as what you're going to be doing is you can't really promise really as high of a preferred return today, and it's really safer for the whole project if you don't start that preferred return until earning it, or being delivered until the property starts making money, because of. And then just keep in mind that commercial real estate always makes more income, more as far as investing in it, more from appreciation than anything else. So for that reason, if you take these projects out 5 years, and you do some value adds, if you're and so on, and raise rents, then you could there's going to be more income from operations, and things are going to be great, and investors will be well taken care of. But until you get to that stage where the property is can afford that return, the passive investors have to be on the same team as the sponsors. Does that make sense?
Oh yeah.
Yeah, it absolutely does. And I like the way you said that, the general partners and the LP should be one team. And I absolutely agree with that. And we tend to look at it from either side of the fence, but you're absolutely correct. It should be, we're all in it together and we're all playing our part in these deals. But going to your point about the preferred return, and I'm really glad you brought this up, because this is friendly debate that we find ourselves having with other people in the space. And look, I think the idea of a preferred return is, for lack of common words, it's just eye candy, right? You're promising somebody to pay out a 7-8% pref, but your property's only cash flowing 4 or 5%. So how is it that you can pay out that 7-8% pref on a deal? And like you said, right, you see the value add space right now, where in our markets here in Houston, Brian and I were just talking about a deal offline before this call. We're looking at a deal that we're investing final for, and it's a C-class property on a 4.5 cap on its actuals.
Sure.
So the reality of being able to really pay out that dividend, all that means is you're putting yourself into a significant constraint that you hope you can make up throughout the execution of your business plan, but that's where the execution risk comes in, right?
Exactly. Yeah. The other thing, because I've seen this happen at times when sponsors have. Like right now, even I have a fairly new syndicator who has a property, and he's trying to promise like a 10% preferred return. And the situation is that what you really, as a passive investor, what you really want, this gets back to making sure the sponsors are making money as well, or just in a good place. What we want to do is you got to realize is that the income is going to be phenomenal. You're going to do really well in this property. Once it sells, or once it gets to a place where the income from operations could pay higher returns, could pay you something better. But until you get there, I can assure you, there's just so much work. If you think about what the sponsor has to go through, from finding the right property, analyzing it, then penciling out the value adds, making sure that you've raised enough money, then actually going for financing, and then making sure that you have a good plan if you do need to turn some units, that that there's going to be a period of time where those units are going to be vacant, and your income is going to be dropping. So as lenders, we in the commercial world, we have to pencil that out, all that. But so you really want, what you don't want is for, okay, then after that, maybe just continue on that thought. But so once the value, you buy the property, the value adds are now getting done, then the sponsor also has to oversee the property management, and they have to run it like a business. So they're going to be putting in hundreds of hours over many years, and you want to so what you don't want them to do is not make any money and then, be in a position where they're wondering how they're going to, make ends meet. Yeah.
Brian, isn't this such a refreshing conversation? Like that, we share the same sentiment, right?
Absolutely. I mean, what you're seeing in the market cycle, we're all seeing lower yields, right? There's very little cash flow, if any, on some of the, especially if you're looking at like an A-class property, right? So at the end of the day, we've seen some crazy prefs. We've seen some 7 and some 8. We've seen some twin. I think we saw one a few weeks ago that was like a 12 or something pref. Where's the cash coming from? Is you really have to ask yourself that as a passive investor. It's nice. Cody used the word eye candy earlier when you see it on the slide deck and it's on the pitch, it's on the webinar, and they're talking about a 12 pref. But at the end of the day, you have to sort of dig into where that money's coming from. And we agree with you, Terry. There needs to be an alignment of interest. You used the word team earlier, and I think that's a great way to describe these opportunities because the team is filled with a lot of players, right? The lender is the biggest part of the team, right? You want your lender to be happy. You want your lender to get paid their interest or their principal, depending on where you're at in the debt. Then you've got your passive investors, right? You want your passive investors to get paid, but then also on the team of the sponsors, they're the ones who put the whole thing together. And if everybody doesn't win, it's a bad day, right? So for us, we want to, the way we structure our deals is we align with your theory, Terry, that you want everybody to get paid along the process because then there's that motivation, there's that alignment to continue to push the property. And then there's also just the reality, like you said, that real estate is, because of where prices are and where cap rates are, it's becoming less and less of a cash flow play. And it's becoming more of an appreciation play. And Cody and I talk about this all the time. We just think it's better to be transparent and upfront say, like, look, this thing only has 4 or 5% cash flow, but we're going with a straight equity split, and we're really going to make a lot of this cash flow on the back end once the property's repositioned, once we've refinanced, or once we've exited.
Exactly, and the thing that's really great about commercial real estate investment is that you don't have these rapid swings like you do in the stock market. I mean, for those investors it's really important to also, if you sure invest in stocks, but also invest in real estate as well, because since the 1880s, since they've been keeping records, real estate has always gone up. Of course, it's had dips, and as long as rents can go up, and it looks like we're in a very, we're in an inflationary environment right now, and for a lot of reasons, rents have room to go up. There's an upside. And what I'd like to do is, because this is kind of like, I don't want this to be a negative conversation, because it's so easy to think, oh my God, this is so risky, and this is like, what do we, should we, why would we even make an investment like this? The reason is that what I love about this business, and it is a business, is that there's always things you can do to work smart, as I keep saying. And let's talk about some of the mitigators that you could put in place and to make sure that if you're buying in an overpriced market today, that you're going to come out really well. Okay, the very first thing is that as far as the finance, because financing is my specialty, let's just start with what you want to do is get financing for this property that has between 2 and 4 years of interest-only payments. What that's going to suddenly do is give you cash on cash return, which you're not going to have hardly any of. What's happening is that the sellers are actually making, if you just get, regular, even though interest rates are really low today, they're really good. But if you take those interest rates and you add interest-only payment, those low rates, and make them interest-only payments, now the property is going to be cash flowing. Okay, also, what you want to be, as far as your value adds, of course, the very best value add is always, and this is in my book too, I have a couple of chapters on repositioning, and I really recommend that, if you're a passive investor, that you really learn this as a business. In my book, yes, I am trying to sell my book, but also the book really is a total course on commercial real estate. But anyway, so what you want to, if you're buying a property that is under market rents, well, that's the easiest one, because if the market shows that these rents could be increased, then you could go ahead and put that in. I mean, it doesn't really, it's a very unusual business, because if you were to buy, somebody was selling you, I give this example quite often. Let's just say a tire store, and they said, okay, well, it's not making this, we're going to sell you this tire store, not based on what it's making today, because it's really doing pretty crappy right now. but we're going to sell it to you based upon how it's going to be doing in 2 years. Because what you're going to do is you're going to do this value add, you're going to do this, you're going to do that, and that's kind of like what a lot of listing agents do when they're selling these properties today. And so it's like, well, why would that even make sense? The reason is because appreciation is something that it's a gift. You don't have to, it's the one part of this, it's the largest part of your income, and you don't have to work hard, you don't have to work for it, really. It just happens naturally. So anyway, so we as far as like doing value adds, okay, or as far as putting yourself in a good position, what you want to do is get interest-only payments on your loan for at least the first 2 years. And what that also does is it makes the project financially pretty bulletproof, because it lowers your break-even point. Because now the property doesn't have to have as much net operating income to pay all the expenses in the mortgage payment. Does that make sense?
Absolutely. It absolutely does.
Yeah. So that's where, it's like that's why I'm talking about working smarter. So you have interest-only payments, you want to choose the right value adds. Gingerbreading is really where you want to be these days. A property that needs, new floor coverings, new paint, new landscaping. These are not really expensive things. New signage, maybe, and new branding, and really top of the line management. You want to take a look at what you want to do is shop insurance competitively. That is like if you go through, I hate to say this, but it's the truth. If you go through just an independent insurance agent, they have to make a commission, which is about 15%. So if you just buy, let's say, insurance directly, you get like State Farm and Farmers and some of the really big names to actually compete against each other for your insurance, you're going to end up with a much lower premium. And wherever you can, you want to do the value adds by raising income and lowering expenses, and choosing value adds that are not going to be that expensive. It's not a really good time to like change the configuration of the units. Perhaps,
Yeah, Terry, and that's a great point right now, is choosing your value adds wisely, because especially what we've seen is with syndication being such a primary strategy over the past decade, is you've seen a lot of these opportunities traded hands over hand 3-4 times just in a short time span, and everybody's implementing their value add, but what all they're doing is looking at the cosmetic components of that value add, but they're really not addressing the underlying infrastructure of the buildings, right? The old
Right.
piping, the electricity, things like that, which eventually it's bound to happen. Somebody's going to get caught with that burden of a busted water line or something like that, which will be devastating to your property. So I think that's something else to be taken into account, especially when.
we have to get back to something more serious, but just to lighten this conversation up a bit, I'm going to tell you a story, which is in my book, with exactly what you're talking about. I had a client that she was an older lady, probably not even older than I am today, but this happened a number of years ago. But this was in Louisville, Kentucky. She bought like an 18-unit apartment complex. She had retired, and this was going to take her through her golden years. And what happened actually is that about 2 months after she bought the property, her tenants started complaining, and her manager just couldn't deal with it, that there was a problem with toilets. And the problem, actually, once they looked into it, the problem had to do with a cast iron or just heavy metal sewer line that went underneath the property. The property was really old. It was built like during the 30s, 40s, and so that had corroded, and now methane gas was just randomly coming up in big. Methane gas has a lot of power behind it. So what happens is when somebody would flush their toilet, when it was timed with the methane gas releases, the contents of the toilet would quite often go into somebody else's toilet instead of the sewer line. So because there was something, as it was going down, there was methane gas going up. And so it was an interesting dilemma. And so anyway, so what you're talking about, that's kind of like the worst situation, I think. Yeah. And it's just, So, so this is a good reason why, buy for the same price, practically buy a C plus property where somebody has really gone through it and taken really good care of it. It's not going to cost you much, much more or any more than, than just C minus property.
Yeah, I mean, I think you're seeing a shift in a flight to quality right now in this market cycle, right? Where, like you mentioned, the C class product is trading on a 4.5 cap, and there comes that added execution risk because of the capex burden, because of the unknowns. I mean, you're dealing with a different demographic, which means you're going to have to work harder for collections and things like that.
Yeah.
So,
exactly. And this brings, so I'd like to get back to also getting back to these mitigators to make where you can invest safely and smart and get a great return down the road. It's okay. So what you really want, part of work with another reason to really work with an experienced sponsor today is because they're going to really do very thorough due diligence. This is not a time to, it's like I talk about buying commercial real estate like dating, where at first, oh, I love the looks of that one. That's the one I want. This is going to be so great. You can't wait for the honeymoon to start. And then you start going, and it's not until after you've sometimes bought the property or actually now you're in a relationship with that person that you find out, oh, this is not who I thought it was. Well, an experienced syndicator sponsor is going to be able to do their due diligence so thoroughly that they're going to know exactly what they're buying. They're going to have a very thorough property condition report. They're going to really go through the financials and the historical financials with a fine-tooth comb and know what they're buying. And they're also going to know that market from the financial standpoint, and the value of that property, what they're buying. So,
yeah, there's tremendous value in leaning in on that experience of an experienced operator to help you go through that. And I would imagine one of the other things that they would probably tell you, I don't know if this is one of your mitigating factors, is coming into these properties well capitalized, making sure that you have those reserves on hand to weather those storms.
Thank you, Cody, for bringing that up. That's actually the most important thing, because my company, Business Loan Store, that's the one that I started in 1997. And anyway, but actually what I found is that all businesses have seasons. And if they didn't, they're seasonal, they did better during certain months, and certain months they didn't have any income. And having working capital was the key to whether a business was successful or not. So I always made sure I lent a business working capital if they didn't already have it. The same is true because an apartment building is a business, and it needs working capital as well. All my clients that actually had either multiple sources of income or working capital, extra cash, made it through the Great Recession just fine. Those that just had to buy that next property and were pretty much broke, did not make it, the majority. So yeah, working capital is really important. In my book, I go through 12 recession-proof strategies and if you just took half of those and applied them to your investment, you would really be building in a lot of insurance that your deal is going to be successful.
Terry, let's take a quick moment. I know we referenced it in your bio or introduction with Brian, but go ahead and give us the title of your book one more time, since we've referenced it a couple of times.
It's actually called The Encyclopedia of Commercial Real Estate Advice. And this is actually the publisher, Wiley, they published the Dummies books. They actually, one day I just get this email from the executive managing editor there saying, hey, Terry, we read one of your articles on LoopNet. We love your writing. Would you be interested in writing this book? It was called, at that time, the Commercial Real Estate Encyclopedia. I thought, oh my God, that sounds so boring. Ugh, who wants to, that's not a book I'd like to write. But I thought, oh, well, it would really be, I've always wanted to write a book, but I didn't think about it. Because I read a lot of articles and stuff. And so anyway, my book is actually, so what it actually is, it actually has everything from A to Z on commercial real estate, every type of commercial property actually, but also it really trains you on how commercial properties make money. And it's just full of pitfalls to avoid and, all kinds of opportunities that, where the opportunities are. But what I love the most about the book is that I'm actually kind of like a natural entertainer. I love speaking in front of groups, and I just said to the publisher, so I said, yeah, I'm really interested in doing this, but I can't write a boring book, an encyclopedia. And so what I did, is what I did is instead of just making an encyclopedia, I proposed to them a book that was half encyclopedia, half how-to book. So what you have is you have two subjects. Let's say the very beginning subject is buying, 2 chapters on buying, and then it's followed with the encyclopedia section on buying. And so anyway, what I do is I tell a lot of really rich stories, just like the one I just told you, for my clients, just to make it more interesting and readable. So
stories is where it's at, man. That's what people want to hear, right? They want to hear the real stories because that's what resonates most.
Yeah.
But well, we'll make sure to reference that book in the show notes, Terry. We'll make sure to get that out there for you. We'll make sure the audience can get a copy of that. So we're looking forward to diving in as well. But so I want to go back to the mitigating factors here. Brian, make sure you heard me correctly. So it sounds like having an experienced sponsor on your team, making sure that you have the right debt terms, and particularly hopefully having a property that can qualify for, several years of IO period. And then at least having some type of capitalization going in to be able to weather any unknowns.
Right. Yes, it's so important. Yeah, it's like, like what I've seen actually investment groups being put together where nobody has any responsibility. There just isn't enough money. It was undercapitalized. And that's not a good scenario. It's so unnecessary. What you want to do is raise a bit more money for that rainy day fund. And because you don't really want to go back and say, hey, I'm really sorry to ask you this, but I need you to put in another 10,000 this month or whatever, or you have to borrow the money in some way. And it's like, there's nothing that you could do that will make the property more recession proof. And then also just protected against unknowns than having that rainy day fund. So that's probably the biggest one, Cody, right there.
Absolutely. Terry, one other thing that we like to do as well, and we encourage all of the other underwriters as well, is to really, you got to stress test your deal, especially right now with valuations moving, you're buying properties at different valuations now, but really putting that through a stress test to see what different factors can this property weather, whether that be a drop in the NOI, whether that be a contraction in the capital markets. Hey, maybe the markets turn and you're now finding yourself in a dip. What do all those factors look like? And if you can make sense of that with all the other variables that you mentioned as your mitigating components, then I think that's why that you can feel comfortable about your assessment. Would you agree with that?
Oh, absolutely. No, yeah, it's like you just brought up another really important factor in this being successful, and that's actually being prepared for dips in the market and stressing the deal out. It's like as lenders, with commercial real estate, we always stress our deals out. Like when if I make a 10-year fixed rate Fannie Mae loan to you today at, let's say, 3 3/4 or 4%, what I have to do is I'm going to have to stress that rate when I underwrite it to 5 1/4. You know why? Because rates could actually go up that high. I want to make sure that if you need to refinance this property someday, that there's going to be that you could handle a 5 1/4 rate. And also the other thing we stress out is all repairs and maintenance. I don't know why it is, but so many, especially inexperienced sponsors, they'll just, what we find is that sometimes the operating statements just don't show that much repairs and maintenance. And so we beef that up. This is where bringing in, working with an experienced syndicator is so important. So we beef that up, and we're not going to, we see, oh my God, you've only spent like $375 per unit that last year. No, you can't do that. We're going to bring that up to $675, $750 per unit or something per year, something more reasonable. And an experienced, sponsor will also stress, as you say, the deal out to handle just these unknowns. Yeah, that could happen.
Absolutely. I think, Cody, we talk about this, right? I'd rather invest as a passive investor in a deal that has a lot of reserves and extra capital put aside and sort of over budgeting on assumptions, even though on paper it looks like that's pushing the returns down. Because to me, that just means there's that safety net there, right? If like, for example, with your R&M budget, with your CapEx budget, if you have a little bit more cushion and you end up not spending it because you're a good fiduciary and you're able to get things done, then everybody wins because your returns are going to go up. Or you see these deals sometimes where everything's marginal, everything's thin. There's not enough CapEx injection. There's not enough capital reserves. If you don't hit it just right, it's not going to be a good day. Yet you're seeing these 8-10% returns, and then things get a little iffy. So I definitely agree with Terry's point that you want to make sure you're with an experienced operator, that there's the right amount of capital set aside just in case there's a bad day, because nobody has that crystal ball and nobody knows when the market's going to turn.
Yeah, absolutely. And what an experienced sponsor is going to do is probably do a 5-year pro forma and just really show the property where it's today, to show where once rents have been raised and the value adds have been implemented. And then, realistically, you're going to see in 5 years that you're going to hit some amazing marks, and it's good to do maybe 3 or 4 of those or 5 of those scenarios to see, so you could take a look at just to kind of ballpark where the market's going to be, and just where this property is going to end up like in 5 years. So,
Terry, I think we've been having this discussion for a while and encouraging people to really look at this decade as the decade of the operator. And where,
oh my God, yes,
I think operations are going to be so important right now, especially with yields getting tighter, cash flows getting tighter. Especially when you're buying properties the way we are now. So, having that experience on your team, somebody that knows how to operate these buildings and these pro formas and execute, is going to be so crucial. And I think, just to piggyback off everything we just spending time on, having that experienced sponsor on your team is going to be invaluable.
It's so important. What I found is that experienced operators, sponsors, the same people invest with them over and over again, and they're also the experienced sponsors. I'm sorry, the experienced passive investors also have taken the time also to learn this as a business as well. So they understand just enough to appreciate what their sponsors are doing, their operators are doing. And so it's not to say that it's not a risky business, but it's just like anything else. It's like I just recently had, I don't know, 5 months ago I had eye surgery, on my retina, and so I'll tell you, like the retina is like it's like the television screen in the back of your eye, and if that goes out, that's it. You're blind in that eye. And so I did research. I picked the very best, retinal surgeon on the West Coast. Because he knows what he's doing. It was a very technical, very, surgery. And now my sight's getting so much better. And in that eye, and I know it's because of just choosing somebody who knew what they were doing. And it's just, and it's like, it's a very, commercial real estate is a technical business. If there's a huge learning curve, and it's a great investment. And it's so important that if you, as an investor, to diversify into real estate, not just into real estate funds, but you'll never make as much as you will from actually owning part of a property. Also, which is great, is you get the depreciation as well. This year as a sponsor. I'm sorry, as an investor, you get that your share of the depreciation, which will save you money on taxes too.
Yeah, Terry, I want to go back and highlight the comment you made earlier. Like this episode for sure is not a doom and gloom or negative type of outlook on the commercial real estate space. Look, we are passionate about this investment vertical. We love and breathe and do everything commercial real estate. And I agree with you. I think this is, probably going to be some of the best years to buy commercial real estate. A lot of people are going to do very, very well over the next couple of years. I think for us, our our biggest passion behind this podcast is to provide people with the education they need to make good, sound investment decisions. And I think all of the conversation we've had today is right in line with that. And so we want to thank you for that and appreciate your expertise and experience. And Brian, we definitely got to have Terry to come back, because I think we just barely scraped the surface.
I'd love to come back. It's been fun. Yeah.
Yeah, Terry. I mean, we'd love to have you back, because I think, man, we can go so many different directions in having this conversation and whatnot. But we look forward to that. We appreciate you being on the show with us today. And before we go, we do have a few more questions, man, and we'll wrap up from there if that's okay.
Sure.
Awesome. Well, Terry, what do you like to do for your own continued education to further your own business?
Well, actually, this is something that I think, to me, I love crunching the numbers, but I also love doing market research. And we subscribe to several market research firms, but actually, it's really amazing to actually, when we are getting ready to make a loan in a market, actually study that market. And it's really hard. And that's just something that I actually enjoy doing. Actually, just uncovering all those, lifting up those rocks, seeing what's under them, seeing, based on what is this property going to appraise at, talking to appraisers, I'm not sure if I answered your question, but
no, absolutely. Yeah. You're just staying in tune to what's happening in the markets as your business.
That's something I really enjoy doing. Otherwise, actually. So,
well, looking back across your career, Terry, what was that one defining moment in time that really changed the trajectory of your career?
Well, actually, to be totally honest, I was actually as a mortgage banker in 2008. We were actually originating for Lehman Brothers and IndyMac Bank. We were top producers, and we actually found ourselves, what we were doing is actually selling our loans simultaneously at closing. And it never occurred to me that a huge, one of the largest financial institutions in the world would go belly up. And so what happened, and this is not a story that I do tell this, but there's nothing I could have done about it. But during several months, actually, we found, actually it was probably more like a month and a half, our firm found itself that people were at the closing table signing documents in our company's name. And then we found that there was the wire never arrived. That's like a very bad place. So even though I can't say, fortunately our firm never got sued, whatever, but it would give some people the appearance that our firm did not have integrity. And for me, that was a defining moment where, so for that reason, I'm not going to put myself or our company in that position again. There's a lot of people out there who pretend to be somebody that they're not. And what it really got down to is that I was actually a middleman I was a middleman at the time. And actually we do the same thing today. We represent a lot of, sources of funds. And the problem is that for me, it was just a defining moment, because I realized that my integrity in my business and promising, what I love the most about our company, Apartment Monster, which I haven't brought into this, that's my, our apartment lending business, is that we have a 97% success rate of closing our loans as proposed. It's not just closing them, but closing them as proposed. And so once that happened to me, where I actually could not even deliver the money at the closing table, that my real, closing our loans as proposed is like the most important thing to me today from that experience.
Absolutely. Well, Terry, I know you kind of alluded to a couple of great points during our conversation, but what would be some advice you would give to the listeners to help them grow their business?
Okay, if you're talking about commercial real estate, I would say, get involved with the deal, at least for its most essential parts. And a lot of people who have not made money in the stock market at times, or when it's gone down, they blame their financial advisor. And what you really need to do is just know just about 5 different components. You really do want to take a look at where the net operating income is and how it relates to the debt service coverage ratio. So net operating income, debt service coverage ratio. You want to take a look at where market rents are. You want to just be involved. You also want to make sure what the cost of the value adds are. And then you want to take a look at the return on your investment that the syndicator sponsor is promising you, or not necessarily even promising, but is pitching. And you want it yourself. It's just like, what you want to do is, like, if you were to hire an employee today for a really important position in your company, you'd probably do a background check on them. And so what you want to do, in a sense, is really do a background check on the deal. Just know enough about the due diligence that you don't just take the word from this sponsor that the deal is going to be earning this or this much cash on cash. Look at the numbers yourself. Get involved. Does that sound good?
Great advice, Terry. Great advice. All right, Terry, tell listeners how they can learn more about you, get connected with you, and give us the title of your book one more time.
Okay, the title of my book is The Encyclopedia of Commercial Real Estate Advice, and it's now being offered 30% off on Amazon. They have a special sale going on, and my company is a apartment loan store, and we do every type of anything from community banks and credit unions to Wall Street money, Fannie Mae, Freddie Mac, FHA, insurance money. We represent it all. So
awesome. Well, Terry, we want to thank you again for the great conversation. Look forward to having you back on the show here very soon, and look forward to staying connected.
Thanks, Terry.
Okay, thanks for having me on. It's been great.